Good afternoon. We'll get started in a couple of seconds, and thank you all for joining us today. As a reminder, this video is being pre-recorded. We will have the contact information for the presenter if you would need to contact them afterwards with any questions, or we will do our best to get it to them. Thank you. Once again, thank you for joining us this afternoon. My name is Jody, and I am the Adult Research Programmer at the Fredericksburg branch. It is my honor today to introduce Catherine from United Way, who is going to be doing a presentation about Intro to Credit. Catherine, if you are ready.
Hi, everyone. Welcome to the Intro to Credit class. Today, we're going to be going over a lot of different topics. Our objectives for today will be to explain why a person may need or want credit, the different components of a credit score, how they are calculated. We will also be learning how to pull a free copy of your credit report. So all good things. We're going to get started right away with why is credit important? What impact does a credit score have on our life? There are so many things that are impacted with credit. It can impact whether you qualify for a lower interest rate when buying a home. It is looked at when applying for an apartment. Also, insurance will be highly affected by credit. Typically, the higher your credit score, the lower your insurance is, and the lower your credit score, the higher your insurance is. It is a huge contributing factor. And so it's important to have that good credit. Same with banks and other lenders. They will look at your credit score for any potential accounts that you're wanting to open. And also, employers typically will look at our credit score when we're applying for jobs. All of these things affect our day-to-day life. And so it's important that we have a good credit score. When we have a good credit score, a lot of times we will be able to pay lower deposits on utilities. Sometimes we can get better terms on cell phone plans. We can get approved for better credit rates, better loan terms. And so all of these things, they affect our daily life. And so having that good credit score is so important. But how does that come to be? What is the process that happens in order for us to get that credit score? How does it all work? Well, typically there is a cycle that happens, and it starts when we open up our first line of credit, whether that be a credit card, a loan, whatever it may be. The second we start using it, it's all collected and creates your credit history. Your credit history is simply a list of all of your transactions that go into your credit report. Your credit report is created based off of your credit history, and it is a report that shows your credit worthiness. It just shows how well you have done at paying off accounts in the past. This credit report is then used to be turned into a credit score, and that credit score is what impacts so many areas of our lives. It all goes through that cycle. And so it's incredibly important to understand that this is how it works. Credit can be a great thing. It can offer a lot of convenience and give people greater purchasing power than they normally would have. It can be good with future planning, and it provides opportunity for us to build credit. There are so many benefits to using credit, but there are also so many downfalls. And if we are not careful with using credit responsibly, it can lead to debt quickly if we're not careful. And so it's important to understand how credit works and understand how we can best use this tool to benefit us and not let it control us. So in the previous slide, we talked about that credit report and the credit score. A lot of times these words are used so often that it can sometimes be difficult for people to understand what the difference is. I know I've had people a few times that have pulled their credit report and they did not understand that it did not have their credit score on there. So what is the difference? Well, a credit report is a detailed breakdown of how well credit accounts are paid. It shows our credit worthiness, whereas our credit score is a number that shows our credit worthiness. It is our grade, if you can look at it that way, that we get based off of the information from our credit report. Our credit report is going to be the breakdown, the nitty-gritty details, the accounts that we've had, the delinquent accounts in our record. All of those details will be found on your credit report. Your credit score is simply a number that is used to give us that grade, if that makes sense. When we pull our credit report, which you can pull a free annual credit report once a year from the 3 major reporting bureaus, and that is Equifax, Experian, and TransUnion. You can do this on annualcreditreport.com. It's an extremely easy process. You just pull up this form that you guys see on the screen and fill in your personal information in order to pull your credit report. It is incredibly important for us to pull our credit report every so often. It's important that we make sure that the information on there is accurate. We don't want it to portray information that is not accurate. We also want to make sure that we are aware of everything that is on our credit report. When we're looking through it, we want to make sure that there aren't any accounts that we may have forgotten about or not realized that we had open. We want to make sure that all of the accounts on there are accounts that we have opened and that there is no fraudulent activity that's going on. And so it's important that we do pull our credit report once a year to make sure that the information that is on our credit report is the most factual, the most accurate, so that we can get the most accurate credit score. There are so many things that we could look at when we pull our credit report. And so I did create a little list for you guys to look through. You can take a moment, screenshot this, take a picture, and next time you're looking at your credit report, look through each of these credit report checklist items and make sure that your credit report is accurate. Make sure that there are no red flags. Make sure that you are not a victim of identity fraud, that all of the accounts on there are in fact yours. Make sure that if you have closed an account, make sure it's actually listed as closed. Make sure that your debts are shown accurately. Are there debts that maybe you've paid in full and when you pull your credit report, it's still showing them as being due? That can have a huge impact on your credit report. And so making sure that's accurate is incredibly important. Make sure that your personal information is correct. Is your name spelled correctly? Is your social security number correct? Are there maybe addresses that are being associated to you that you no longer live at or that you never lived at? It's important to make sure that all of these things are accurate and that you're looking through them annually. So again, take a moment, take a picture, look through each checkpoint. We're not going to go over every single one of them today, but look through them. And when you get a chance, pull your credit report, make sure everything on there is correct. Now, we know that our credit score is based off of our credit report checklist. So what constitutes a good score? There are many different levels with credit scores. You have your poor, fair, good, very good, and excellent. And there are different ranges for each. And so this is a good thing to keep in mind when you pull your credit score to see where do you fall within these categories. Are you in the good range? Or maybe you have made some credit mistakes that have lowered your score. Maybe you find that you were in that fair category or you were in that poor category. Maybe you are in the good category, but you're wanting to do better and you want to increase your score. It's incredibly important to know where you're starting in order to know where you're going and where you want to be. These are different credit report levels, but how is it that we get to this point? How is your credit report your credit score created? We know that it's based off of your credit report, but what are the specific things that affect it? You'll find that credit scores are a lot like back when we were all in school and different assignments had different impacts on our score. We all remember when we were in school and maybe a huge test would affect 30% of our grade. But our homework assignments, those were only 10% of our grades. They weren't as important Did they affect our grade? Yes, but not as much as that big test. That was 30% of our grade. Credit scores are a lot like that. There are many different things that go into it, and they all affect our scores in different ways. If you look at the graph on the screen, you'll notice that that dark blue is the biggest section. That is 35% of our score. 35% of our score is our payment history. Have you paid your accounts on time every single time? That is 35% of your credit score. It's incredibly important that we make sure that our payment history is up to date and that we pay our accounts on time. Don't let credit accounts go past the due date. Make sure that you're constantly paying them on time. The second largest section we'll see is credit utilization. How much do you owe and how much of your available credit have you used? Do you have a maximum of, $3,000 on a credit card and you're using 2,000? Are you close to maxing out on all of your cards, on some of your cards? All of that has a huge effect on your score. It is 30%, so that's pretty significant. And then length of credit history. That is the third largest section at 15%, smaller than the other two for sure. This is one of those things that we don't have much control over. We'll find that a lot of times with credit, the only thing we can do is make good decisions and then be patient and give it time. A lot of things take time when it comes to credit, and length of credit history is just one of those things. So that's not something to focus much of our time and attention on because there's not much we can do to change it other than give it time and wait. New credit is 10% of our score, and that is how much of our available credit is new. Have we recently gone and opened up a lot of new credit? A lot of times that can just make us look a little bit riskier to lenders, and it can affect our credit worthiness. And so it's important that we don't have a lot of new accounts all of a sudden and that we limit ourselves to only opening what is truly necessary. Lastly is credit mix, which again is 10% of the score. What is your mix of credit cards? Do you only have credit cards or do you have other accounts such as retail credit, student loans, mortgages, car loans? Having different kinds of credit and being responsible with all of them shows that it helps with our credit worthiness because it shows that we're responsible in many different areas, not just one. And so having that credit mix can just help with our credit score. When we look at our credit score, it typically shows you a few different things. First thing it will show you is, of course, what your credit score is. And so again, it's important to know where we're at in order to know where we want to go and how to get there. And so one of the first things that you should do if you're wanting to better your credit score is to find out where you currently are. Below that, it'll show those different areas. It'll show your payment history, your debt amount, length of credit history, new credit, all of those different categories. A lot of times it will let you know how you're doing in those categories. It will say you're doing excellent, good, fair. And so it's important to know what categories we're doing good in and what categories we can be better at. The bottom section will show positive factors that are impacting your score positively and then negative factors. Again, some of these negative factors you may find are things that you don't have a lot of control over. It may say your length of credit history is affecting your score. That's not something we can really change from night to day. That takes time. It may show that you have some delinquent accounts on your record. Maybe you didn't pay some of your accounts on time and they became delinquent accounts. Those are things we can change. But again, we have to be patient and make those adjustments and then give our credit time to adjust. This is a good screen to look at in order for you to develop a plan to increase your credit score. Look at what negative factors are impacting you and where you can be better with your credit score. Create a plan to how to address those specific categories and then just be patient. It takes time for credit scores to change, but as long as you're following habits. that address those factors, you should see your score rise. Payment history, as we said, affects 35% of our score. Research shows that your track record of payment tends to be the strongest predictor of the likelihood that you'll pay all debts as agreed to. It makes sense. If someone had borrowed a lot of money from a lot of different people, and then they came to me and asked to borrow money from me as well, and I knew they hadn't paid anything back, I would be less likely to let them borrow money. I would be less sure that they would pay me back. Same goes for most lenders. When you allow an account to become delinquent due to non-payment, it takes time for that to come off your record. In fact, it affects your credit score for 7 years. And that's why I said before, when we create that plan of how we can put habits into place that will help increase our credit score, we have to also understand that it will take time in order for that to build. And that's okay. Keep note that the effect that it has on your credit does diminish over time. So if I allowed an account to go delinquent a year ago, that's going to have a higher impact on my score than if it were 5 years ago. And so the effect does diminish over time. But even if you have made certain mistakes that have led you to any of these areas, making that switch and putting those good habits into place will help you in the long term. Just be patient. Credit utilization. How much of our credit are we using? It's incredibly important to keep this in mind and to keep track of this. Ideally, your credit utilization rate is recommended to be 30% or lower. So when you are approved for a line of credit, it's important to do that calculation up front. The second you get your credit limit, find out what that 30% is and make sure that you do not go over it. In fact, stay far under it to be safe. Further than this, it's important that you don't charge more than you can pay off. So if 30% is still too high of a number for you, decide what is your number. How much are you comfortable putting on credit, knowing that you can pay it back in a reasonable amount of time? So credit utilization tells a lender how much debt you carry and how much of it you are currently using. So make sure that we're looking into this and that we are staying below that 30%. Keep in mind that this affects 30% of our score. Lastly, available new credit. Like we said before, your lender is trying to see if you've taken out a lot of new credit. Do you have a lot of new credit cards? Are there new car loans, new student loans? There's no specific rule as to how many you're allowed to have, but typically you don't want to open a lot of new credit cards at once. A general rule of thumb is just don't open more than what is necessary and keep track of what credit cards you're opening. Because remember, all of these things affect our score. And so it's important that we focus on the things that we are able to control. Truly, the two biggest things that will affect your score, again, are payment history and credit utilization. If those are the two things you take away from this, I will be happy with that. Keep track of how much credit you're using and that you're paying your accounts on time. If you guys do have any other questions, please reach out to me. You will have my contact information, and just let us know of any questions you may have. Thank you.
All right. Thank you again, Catherine, for that wonderful presentation. I know I learned a lot today. I did have one question, if you could possibly answer it. I've heard in the past that medical debt cannot count towards your credit. Is that true or not?
Medical debt can count towards your credit, as typically when it is not paid on time, it is sent to a collections agency, and collections agencies do report to your credit report. Typically, as long as you're paying something towards your medical debt, it cannot be sent to a collections agency. So keep that in mind. Just pay something towards it every month.
All right. Thank you so much. And again, thank you, Catherine, and for United Way for this wonderful presentation. We hope you all enjoyed it, learned something new, and we will see you all next time.
Great. Thank you.
Bye.